learning about few advanced options trading strategies, wherein we will understand how these strategies work in various market conditions and typically which strategy turns out to be a better strategy in one of the market conditions, because there are many option strategies out there, right? So not each and every strategy will be helpful for us in every market condition. So we will understand various aspects looking at the option Greeks, obviously, and then we will try to construct ourselves, the best option trading strategies. So we will be using Architect and tools like Optimizer in order to build ourselves the option strategies and analyze them. So access these tools from the link in the description box below, and also the link which is there in the iCard. Okay. So let's start by first understanding the theta component. So whenever we are closer to expiry, the theta starts decaying at a very faster pace. Okay. So now, how can we tackle this problem? So one of the ways to tackle this problem is, and we have discussed it a lot of time, it is we can go ahead and create a bull call spread. Okay, so now let's say I have created this strategy, 17, let's say 800 call option I have bought it. Okay, and now the problem is whenever the theta starts decaying at a faster pace, which is when we are closer to the expiry. Whenever the theta starts decaying at a very fast pace, what I can do is I can click on add leg and convert this strategy into a bull call spread. Okay, so many people do it. So this is something what is picking up the pace recently in the market. A lot of traders have started to practice bull call spread. Okay, so over here, net your theta will get a bit offsetted here and there. Okay, you will not be completely theta positive, but at least compared to a long call, this is a far more better strategy if you look at it from a theta perspective. Okay, now if you want to take this to an advanced level, what you can do is, now you have sold one lot of 18,000. Instead of that, you can add one more lot. Okay, instead of that, you can add one more lot and convert this into a ratio call spread. Now if you see the theta, if I just go to Greeks, and this will be, by the way, showing us positional Greeks. So the theta is positive by 161 points. So the best part about this strategy is, now, if your stop loss is triggered, that means if the market goes negative the moment you create this strategy, so you will not be at a bigger loss. You will not face an undefined loss in this strategy on the lower side, on your stop loss side. You have a bullish view on the underlying, but on the stop loss side, you will not face a heavy loss. Reason? Because you have one call option which you have bought, which is trying to protect you. Now the theta, which is acting like a very good friend of yours in this strategy, because you have sold two lots additionally. So more time markets spends in this range, the more profitability of your strategy increases. Okay, now you can, so this is for much more advanced traders. The reason I'm telling you that, it looks simple, but now just check this thing out. Let's say if the market goes to, if your view goes right, okay, now understand why this is tricky, because if your view goes right, still this strategy might start giving you a loss. Now let's say you had a bullish view, market went to 18,236, which is, your view is correct in the market, right? But this strategy will end up giving you a loss of roughly around 5,000. Why? Because you have an additional short leg.
He Traders Quantsapp has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you.
In your basket. Okay, so if you don't, if you are not a very experienced trader, instead of this, you should always go ahead and hedge this strategy. Instead of a naked both sell legs open, you can hedge this strategy, convert this into a butterfly, and you can enjoy the theta decay as well smoothly. Okay, so you don't have to worry about theta decay. You are still getting some theta decay. Obviously it will not be as high as ratio, but it would be still better than a long call. It will be still better than a bull call spread. Okay, if you are a very if you are a trader who can bear undefined risk, then ratio call spread is an option. But if you can't bear undefined risk, butterfly is something what, typically I would say, instead of taking undefined loss, this is one of the strategies which one can try to analyze. Then another one is, let's say I exit one of my leg, okay, or one of my lot. Again, it gets converted into a bull call spread. Now what I'll do is, instead of selling two lots of 18,000, which will give me a V payoff on the top, right? There was a ulta V getting formed on the top. What I'll do is I'll sell a 18,100 strike price call. So I'll get a much more flatter payoff on the top. At the same time, I will get much more buffer on the upside. Okay. So see now at the same level, 18,236. In the previous strategy, in the ratio spread, I was making a loss of roughly 5,000. This is giving me only a loss of roughly 1900 or 2000 approximately, correct? So this is called as bull call ladder. And another thing is you can try to harness this here and there a bit, and vice versa can be done obviously for the put side too. Okay, so whatever I am showing, you can do it for the put side as well, which is also fine. So if I just show you at the same level, 18 to 36, so somewhere around that, if you just create a different strategy, which is bull call ladder, that means you haven't done anything complex here. Only the point is you had sold 18,000 ka two lots. Now you are selling 118,000 and 18,200 too. Okay. So this is when you are bullish on the instrument. If you are bearish on the instrument, you will do the exact same thing, but with the put side. Okay. And this is when we will do this type of strategies, when you are getting closer to the expiries and you want to churn a lot of theta, which is flowing out from the money. Okay. So instead of a plain vanilla long call, bull call spread is obviously better. But better than that, whenever the theta is decaying at a very fast pace. So all these strategies, what I showed, those were with respect to the when the theta in the market is decaying at a very faster pace. If the theta decay is slow, if you are at the beginning of the expiry, you can typically consider avoiding, long call is one of the good strategies. And none but not the least, if you don't know, only the best solution is the optimizer. You can directly come to optimizer, select any instrument in which you want to build option strategy. So let's say Nifty. Okay. Select, define your direction. What is your forecast on Nifty? Your bullish, bearish, or whatever your forecast is. Either way is oscillate. Okay. Now select the time frame in which you expect this forecast to get achieved. Let's say I am bullish on the instrument till 19th of April and I am bullish till 18,200 and I am setting my stop loss at 17,600. Okay, this is my forecast. Optional parameters, you can define your capital, your risk appetite. Now let's say my risk appetite is only 5,000. Okay, if my stop loss is triggered, my maximum loss I am ready to take on my stop loss. Okay, this is everything I am considering on my stop loss on the target date. You just need to apply. The optimizer will do its job and it will give us the best option trading strategy for our forecast. You can open bull call spread and you can analyze on what various levels how much profit or loss you would make. So do check out Architect and Optimizer and be an advanced option trader and analyze, or I would say create, analyze and trade strategies like a pro.